Welcome back to the Pro Ticker Podcast, everyone. It's our Thursday morning edition covering major financial magazine headlines. Imagine you're, just relaxing after the Christmas craziness, coffee in hand, ready to catch up on the financial world. But you don't want to get bogged down in all the details. Well, that's where we come in. Today, we're diving into a mix of Bloomberg, CNBC, and Wall Street Journal articles, all fresh from today.
Yeah, we've got some pretty interesting stories to unpack. Everything from Cathie Wood's moves with Tesla to some potential issues in the fintech world.
Ooh, intriguing. All right, well, let's jump right in. Even though it's a holiday week, CNBC tells us global markets are still showing some signs of life. Japan's Nikkei edged up a little bit, but China's market saw a minor dip.
Yeah, that's pretty typical for this time of year. Trading volume is usually lower during the holidays, but there are some underlying trends worth watching. Bloomberg points out that iron ore prices are actually ticking upward.
Oh, that's interesting.
Yeah.
And Bloomberg attributes that to Chinese steel mills stocking up before spring construction picks up again.
Exactly, and what's really interesting is that this suggests there's still a good amount of demand for steel in China. Even with all the recent concerns about their construction sector, this could definitely have an impact on global commodity prices in the coming months.
Something to keep an eye on for sure. And speaking of global impacts, Bloomberg also reports that oil prices are holding steady, fueled by China's stimulus measures and shrinking U.S. stockpiles.
Right, and this all sets the stage for what could be a very volatile year for oil in 2025. We have a new U.S. presidency on the horizon with Trump, who may impact energy policy. You've got China, who plays a huge role in global oil demand, and then, of course, there's always OPEC plus decisions looming. All of these factors combined create a lot of uncertainty and could lead to some pretty dramatic price swings.
So if I'm an investor listening to this, I'm probably thinking, okay, how does this oil situation actually affect me? What should I be doing with my investments?
That's a great question. Now, of course, we can't offer specific financial advice, but understanding these global trends is crucial for making informed investment decisions. Definitely talk to your financial advisor, but keep in mind that oil prices can have a domino effect on things like inflation and a wide range of industries.
Makes sense. Okay, so let's shift gears for a minute and talk crypto. Bloomberg reports that Bitcoin is getting a boost thanks to MicroStrategy's plan to issue more shares and use those proceeds to buy even more Bitcoin.
Oh, yeah. MicroStrategy has been a big Bitcoin bull for a while now, but this move is a major signal of confidence. They're really putting their money where their mouth is, which is definitely influencing the crypto market.
Yeah, it does make you wonder, is this a brilliant long-term play or a risky gamble?
That's the million-dollar question, isn't it? It'll be interesting to see how the strategy plays out for them,
Yeah.
especially with Bitcoin's volatility and the regulatory scrutiny it continues to face.
For sure. Okay, let's talk about a company that's no stranger to attention, Nvidia. CNBC reports that it was the most bought stock by retail investors in 2024, attracting almost $30 billion.
Wow. Well, Nvidia's dominance in the AI space is a major driver of its popularity. They're essentially providing the tools for the AI gold rush, and investors are clearly betting on their continued success.
It's a really fascinating example of how retail investors are increasingly influencing the market, especially in the tech sector. But with such a dramatic surge in popularity, it does make you wonder, are we witnessing a bubble? Or is this a justified bet on the future?
It's definitely something to keep an eye on. If Nvidia's growth continues to align with its potential, then it could be a solid investment. But as with any hot stock, caution is always warranted.
Good point. Now, for a move that might seem a bit counterintuitive at first glance, MarketWatch reports that Cathie Wood's ARK Innovation ETF has been selling some Tesla shares, even as the stock price keeps climbing.
Yeah, this is a great example of portfolio rebalancing in action. As Tesla's stock price goes up, it starts to make up a larger and larger percentage of the ETF's portfolio. So to maintain a balanced portfolio and manage risk, fund managers will sometimes sell a portion of their holdings in a stock that's appreciating rapidly.
So it's not necessarily a sign that Cathie Wood is losing faith in Tesla?
Exactly. It's more about strategically managing that portfolio and making sure no single holding becomes too dominant. In fact, by selling some shares while the price is high, they can actually increase the overall value of their stake in the company.
Yeah, that's pretty clever. Okay, this next story from the Wall Street Journal is a bit concerning. It seems that Evolve Bank, a key partner for many fintech companies, is potentially missing millions in customer funds after one of their partners went bankrupt.
Oh, wow. This situation really highlights the potential risks that come with the rapid growth of the fintech ecosystem. You see, fintech companies often rely on partnerships with traditional banks to hold customer funds, and if something goes wrong in that chain, like it appears to have happened here, it can have some serious consequences.
So what does this mean for the average person who might be using fintech apps or services? Should they be worried about the safety of their money?
Well, it's a good reminder to always do your research and understand the full picture when it comes to fintech products. Know where your money is being held, how it's being protected, and what your options are if something goes wrong. While fintech offers many benefits, it's important to approach it with a discerning eye.
Excellent point. It's easy to get caught up in the excitement of new technology. But we can't forget about the potential risks. All right, let's wrap up this first segment of our deep dive by taking a look at overall stock market performance in December. MarketWatch notes that the S&P 500 has had a pretty volatile month, but it turned positive just in time for the start of what's called the Santa Claus rally period.
Yes, the Santa Claus rally. This refers to the tendency for the stock market to rise during the last 5 trading days of December and the first 2 of January.
So is this a reliable indicator of future market performance, or just a fun Wall Street legend?
Well, historically, the S&P 500 has seen positive returns during this period more often than not. But it's not a foolproof predictor. Still, it's a trend that a lot of market watchers pay attention to, especially as we head into a new year. It's kind of like, trying to predict the weather. We can look at historical patterns, but there's always that element of unpredictability.
Speaking of unpredictable,
Right.
CNBC also highlighted that retail investors are really drawn to Nvidia, making it the most bought stock of the year. Do you think this is just hype, or are there more fundamental factors at play?
It's definitely a combination of factors. Nvidia is a key player in this whole AI revolution, and that's attracting a lot of attention, not just from retail investors, but institutional investors as well. The demand for their chips is only expected to grow. They're essential for AI applications, but I think it's wise to approach a stock like this with some caution.
So you're saying it's important to look beyond just the hype and assess whether Nvidia's current valuation is actually justified by its long-term potential.
Exactly. Investors need to consider things like the company's financials, its competitive landscape, and the overall growth trajectory of the AI market. It's an exciting area, no doubt, but it's not without its risks.
For sure. Now let's circle back to that unsettling story from the Wall Street Journal about Evolve Bank and the missing fintech customer funds. What are the broader implications here? Could this incident erode trust in fintech products and services?
Yeah, it's definitely a valid concern. This case really highlights the importance of doing your due diligence. When you're dealing with fintech products, often there are multiple parties involved, so it's crucial to understand where your money is being held and how it's protected.
So it's not just about, the shiny new app or the promise of innovative features.
Right. It's about understanding the entire ecosystem, including the regulatory framework and the financial institutions that are involved. This incident, I think, underscores the need for robust oversight in the fintech space to really ensure that customer funds are properly safeguarded.
That makes a lot of sense. And this actually reminds me of another story that CNBC covered about some major banks suing the Federal Reserve over annual stress tests. We're talking about banks like JP Morgan, Citigroup, Goldman Sachs. What's the story there?
So these stress tests are designed to evaluate whether banks have enough capital to withstand a severe economic downturn. The banks are arguing that the process is too opaque and unpredictable, leading to unnecessarily high capital requirements. And they say that hinders lending and economic growth.
But wouldn't regulators argue that these tests are essential to prevent another financial crisis?
Absolutely. They see these tests as a crucial safeguard for the whole financial system. So this lawsuit really highlights that ongoing tension between banks who are seeking more flexibility and regulators who are prioritizing stability. It'll be interesting to see how this legal battle plays out and what impact it ultimately has on future regulations.
It seems like a really delicate balancing act, trying to find that sweet spot between fostering innovation and mitigating risk. Now let's go back to Kathy Wood and ARK Invest for a minute. MarketWatch highlighted an interesting move that they've been making with their Tesla holdings. It seems like they've been selling off some shares even as the stock price continues to climb.
Yeah, this move initially confused a lot of people, but it actually demonstrates a pretty savvy investment strategy called portfolio rebalancing. You see, as Tesla's stock price goes up, it takes up a bigger and bigger chunk of the ETF's overall portfolio.
So to avoid having too much of their portfolio tied to a single stock, even one as successful as Tesla, They sell some shares to maintain a more balanced and diversified portfolio.
Exactly. This helps manage risk and ensures that the portfolio isn't overly exposed to the volatility of any one stock, even if they're still optimistic about its long-term prospects.
That's a great insight into the strategic thinking behind these seemingly counterintuitive moves. Before we move on, can you elaborate a bit more on what portfolio rebalancing actually entails and how it can benefit individual investors? I know our listeners are always looking for actionable advice.
Of course. So portfolio rebalancing is basically the process of periodically adjusting your investment holdings to maintain your desired asset allocation. This helps ensure that your portfolio stays aligned with your risk tolerance and your investment goals over time. As certain investments perform better or worse than others, their weightings within your portfolio can shift, and that can create an imbalance.
So let's say I'm a fairly conservative investor, and I have a target asset allocation of 60% stocks and 40% bonds. If the stock market has a really great year, my stock holdings might increase to 70% or even more. So in that case, I would sell some of my stock holdings and buy more bonds to bring my portfolio back to that desired 60-40 balance.
That's a great example. By rebalancing, you're essentially selling high and buying low, which can help improve your long-term returns. It also helps you maintain your desired level of risk exposure.
That makes a lot of sense. So it's not about trying to time the market perfectly. It's more about maintaining a disciplined approach to managing your investments over time.
You got it.
Now, before we wrap up, there's one more story I want to touch on. Bloomberg reported on MicroStrategy's bold move to issue more shares, specifically to buy more Bitcoin.
Oh yeah, we touched on that earlier.
Right, it's a pretty big bet on the future of cryptocurrency.
It is, and it shows the growing acceptance of Bitcoin as an actual asset class, even with all the volatility and regulatory hurdles it still faces. Some investors see this as a validation of Bitcoin's long-term potential, while others see it as a risky gamble. It'll definitely be interesting to see how the strategy plays out for MicroStrategy and what impact it has on the wider crypto market.
It certainly adds another layer of intrigue to the world of cryptocurrency. All right, so as we wrap up this deep dive, what are your final takeaways for our listeners? What are the key things they should be watching for in the financial world as we head into the new year?
Well, I'd say there are a few key trends to keep on your radar. First, keep a close eye on China's economic policies and their impact on global markets. Things like their stimulus measures, their infrastructure, spending their demand for commodities, all of that will continue to have ripple effects across the world. Second, pay attention to the evolving regulatory landscape, particularly for banks and fintech companies. The outcome of legal battles like the one we discussed involving those stress tests could have major implications for those industries. And finally, don't forget about the Santa Claus rally and how the market performs in these first few days of January. It could offer some clues about investor sentiment and the direction of the market for the rest of the year.
Those are some great insights to keep in mind as we navigate the financial world. Any final words of wisdom for our listeners before we sign off?
I just encourage everyone to stay informed, stay curious, and don't be afraid to ask questions. The financial world can seem complicated, but with a little effort, anyone can gain the knowledge and confidence to make smart decisions about their money.
Oh, that's great advice. Okay. Well, thanks for joining us today and sharing your expertise.
It was my pleasure.
And to all our listeners, we'll see you tomorrow morning with new headlines from major financials magazines. Until then, stay informed and stay ahead of the curve.